In this video, I'm talking about why now is not the time to stop funding your 401k. Today's vlog is being brought to you by 401k Maneuver. 401k Maneuver provides online professional account management for your 401k with the goal of supercharging its account performance. So stop leaving money on the table each and every year in the form of lost returns. Let us help you. That's real money, you guys. If you're new here, be sure to hit the subscribe button, and the links to everything that we mentioned in this video you can find in the description box below. So let's jump right in. If you're wondering if you should stop funding your 401k because you're having a hard time making ends meet or are nervous about the economy, you aren't alone. A 2023 CNBC Your Money survey finds that 3/4 of working Americans say that they're stressed out about their personal finances these days. And as a result, many investors may be thinking of cutting back or stopping to fund their 401ks. A recent study by Allianz Life Insurance of North America found that American workers are struggling with inflation. And one of the main ways they're handling their struggles is by cutting back or halting their 401k contributions. And here's some of their findings. 54% halted or reduced their 401k and other retirement savings between July and September. Stressed millennials were the most likely to stop or slim their retirement savings due to inflation, followed by Gen Xers and then baby boomers. And even though times are tough, now is not the time to stop funding your 401k. And there are many reasons why you should continue to contribute to your 401k even when the market seems worrisome and inflation is pressing in. So let's talk about gains over time. It's easy to look at the market and worry, but history has shown that it's wiser to continue contributing to a 401k even during a financial crisis. For example, at the bottom of the financial crisis of 2008-2009, the S&P 500 was 683 points. Today it's around 4,200. That's over 5 times off the lows of 2008 and 2009. If I was 41 then, and now I'm 55, by not selling in 2008, 2009, I would have been able to continue to significantly grow my retirement savings. But if I had stopped contributing during 2008 crisis, I would have missed out on this huge rally off the lows. And that doesn't even include your employer match. Here's another example. Just 2 years ago, in March of 2020, the S&P 500 fell to 2,304 points. But today, we're around 4,200 points. It's up over 60% off of the lows of 2020. And while the past does not always repeat itself, we as investors can use it as a guide to make better decisions when faced with the questions. Should I pull back or stop funding my 401k? It's tempting to stop contributing when we feel as if we're facing a financial crisis, but time has proven that it's wiser to keep contributing and trust that there will be gains in the future. Do yourself a favor, check the description box below for the complimentary guide titled Investing More in Your 401k May Help You Beat Inflation. Now let's move on and talk about how Social Security is not enough. We heard for decades that Social Security should not be the only income that you have in retirement, and Social Security should be considered your base income. But it will not be enough for you to retire. It just won't. To retire comfortably, you'll need to draw off your 401k for additional income. And according to the June 2021 National Retirement Risk Index report from the Center of Retirement Research at Boston College, half of today's households will not have enough retirement income to maintain their pre-retirement standard of living, even if they work to age 65 and annuitize all of their financial assets, including the receipts from a reverse mortgage on their homes. And that's not a positive outlook for many Americans. A study by Allianz Life also found that nearly 3 in 4 Gen Xers worry that if they don't increase their retirement savings soon, it's going to be too late to have a comfortable retirement. And the same study found more than 4 in 10 people say they do not expect to be financially ready for retirement when the time comes. Meanwhile, 1/3 of Americans expect to live to 100, with an equal third predicting there is a better than 50% chance that they may outlive their savings. And at the same time, more than 1 in 3 report that they have not proactively taken any steps to address this concern. And since we know that Social Security isn't enough, We should do all that we can to contribute as much as possible to our 401ks, not less. Now let's talk about how a tax break makes it worth it. You get a tax break for every dollar that you invest in your 401k with pre-tax dollars. So let's say you make $50,000 per year and you put in 3% of your pay into your 401k. This is $1,500 and drops your taxable income down to $48,500. The tax break for contributing to your 401k will go away if you stop funding your 401k. And come tax time, you may find yourself with a larger tax bill to pay. Let's talk about how dollar cost averaging is smart. Follow the dollar cost averaging strategy with your 401k from every paycheck. This means you invest a sum of money from every single paycheck, regardless of the current share prices. Dollar cost averaging allows you to buy more shares when the market's lower and fewer shares when the market is high. And over time, this could accelerate your holdings and your returns. It also keeps you from making emotional decisions in the moment that you may regret. Did you know you can get up to 100% return on company match contributions? Check with your employer to see what your company match is and do what you can to at least contribute that amount. Let's say they match dollar for dollar up to 3% of your salary, and if you make $50,000 per year, that's $1,500. The employer then would match that $1,500, thus giving you a 100% return on your contribution. It's basically free money. Even if you decide to stop contributing to your 401k, make sure you contribute enough to get the company match. Now let's talk about when it makes sense to stop funding your 401k. Now that we've covered what you need to consider before you stop funding your 401k, it's time to discuss when it makes sense not to fund your 401k. If you can still manage to contribute and also work toward other financial goals such as paying off debt, it may make sense to pull back on your contributions. For example, if you're getting the company match and you have a ton of debt, you may want to divert some of it to pay off debt. The key here would be contribute enough to still get the company match and divert additional retirement savings funds to pay off high interest debt. This is because the company match is essentially free money that your employer contributes to your retirement account based on the amount you contribute. And if you have high interest debt, it may not be a bad idea to strike a balance between saving for retirement and paying off that debt. Create a budget that prioritizes debt repayment while still allowing you to contribute enough to your 401k to receive the full company match. Another time when it may make sense to stop funding your 401k is when you're nearing retirement and you want to pay off your mortgage. Paying off a mortgage as you near retirement makes sense only if you have additional funds to make this happen. This is usually your largest payment, and it could drastically increase your income in retirement by paying this off early. In this case, maybe pull back on funding your 401k, but not stop completely. Have questions about your 401k performance? Book a complimentary 15-minute strategy session with one of our advisors today.